Hello, YouTube, and thanks for tuning in to the next installment of All Things Trading, the multi-part series dedicated to those who are interested in getting started in trading in the financial markets, or perhaps you've been doing it for a little while and aren't very good at it. This series promises to educate you on everything you're going to need to know in order to master the financial markets. And today, we're going to talk about something that is extremely crucial to order execution, and that is stop losses. So what's on the agenda for today? First, we're going to talk about what a stop loss actually is, the different types of stop loss orders there are, and of course the pros and cons that go along with using them. So what exactly is a stop loss? Well, as the name suggests, it is a triggering mechanism designed to stop your losses. It activates when the stock price drops below or hits a certain threshold. Let's say you bought 100 shares of XYZ Company on the 21st of January, and you paid $134 a share, right about there. A couple of days later, on the 26th of January, you look and see that your shares are now worth $143 a piece, right about there. And because you bought them at 134, you are just ecstatic. You are patting yourself on the back for making such a wise trading decision. You're currently sitting on a $9 per share of unrealized profit. It's unrealized unless you sell it. All profits and losses, for that matter, are unrealized until you hit the sell button. But you are riding high. You think that XYZ Company is going to make you rich, and you can't wait to see what happens tomorrow. Well, here's tomorrow, the 27th of January. It's kind of got you scratching your head. Huh, wonder what that's all about. The price didn't continue to go up. But hey, you know what? This is XYZ Company. This has got super strong fundamentals, and their board of directors are on top of their game. I'm not worried about it. Then the 28th comes, and the 29th. Uh-oh. It looks like your shares are now worth $132 a piece. What was once a $9 per share profit has suddenly turned into a $2 per share loss. Do you stay or do you go? That question is going to be the most frequently asked question you are going to ask yourself playing this game. Do I stay or do I go? Well, you know what? This is XYZ Company. I am not concerned about it at all. Instead of driving myself nuts looking at this every day, I'm going to come back in 30 days and we'll see what riches await me then. And 30 days later, your shares are now worth $121 a piece. Your little loss just turned into a big fat one over the course of 30 days. Now, it looks like there was some time in the first week of February that the price peeked its head into the profit space, but you're out living your life. You're not sitting in front of your computer babysitting the price action all day. That's why we use stop losses. Oh, and this all could have been very easily detected. When we get into technical analysis, I'm going to show you exactly what took place that had pullback written all over it. In fact, if you're watching this video right now and you can see in this chart that's on this screen right now what took place that would have signaled a pullback was coming, put it in the comments below. I'm very interested in hearing your guys' feedback on this. But back to stop losses. Stop loss orders come in a couple of different varieties. There's the stop market, there's the stop limit, and there's also the trailing stop. The trailing stop, we're going to talk about that in a second. But a stop loss is an order to sell at the next available price if the price reaches or surpasses a certain level. And to understand the differences between these two particular stop loss orders, we have to go back to our previous episode where we talked about the differences between a market order and a limit order. So if you recall, a market order is an order seeking execution immediately at the next available market price, whereas a limit order is an order seeking execution at a specific price or better. So just think of it as market order. The market is telling you what the price is going to be. A limit order, you are the one that's deciding what it is you're going to pay. So when it comes to your stop loss orders, the difference between the stop market and the stop limit is that with the stop limit, you are deciding what the price is going to be. You're deciding the price of what you're going to pay, and you're also deciding at what price you are going to trigger the sell order. And here's our online order form once again. And here's how you're going to set your stop. And then again, in this example, we're buying 100 shares of General Motors. And if you recall from the previous video, the order type is how you want your order served up. And in this case, we're going to select a stop market order. And when you select that, you'll see that there is an activation price. And the activation price is where you want your losses to stop, plain and simple. It's the 21st of January again. And if you recall, you bought 100 shares of XYZ Company at $134 a piece. But instead of it being a market order, this time it's a stop market order. And you put in an activation price of $133. So what that means is that when the price at any time drops below or reaches $133, a sell order is initiated. It's not until the 29th of January that the price ever sees $133. And when it does, you're stopped out of position without any further loss. Now, in this particular example, it wouldn't have made any difference whether it was a stop market order or a stop limit order that was placed. So let's talk a second about the stop limit order. So instead of having your stop market as your order type, you put stop limit as your order type, and you'll notice that an additional field will come up, and that's the price. Because remember, with any type of limit order, you are dictating the price as to what it is you are going to pay, and in this case, the specific price that you want the sell order to be executed. Now it's the 12th of February, and you have submitted a stop limit order at $134 with an activation price of $132.50. So what that means is that you have decided that you are not going to pay any more than $134 a share, and you want a sell order initiated specifically at $132.50, right there at that red line. So once the price hits, not drop below, hits that red line, a sell order is initiated. Well, here's the problem. On the 16th of February, the price hit a low of $132.79. And on the 17th, well, it opened at $131.25. This is the difference between a stop market order and a stop limit order. A stop market order will execute at the next available market price. So if it closed one day at $132.79, well, it went right past 132.50 and the next available price would have been 131.25, which is exactly where the stop market order would have executed. But because the stop limit order is specific, well, the stop limit order doesn't get executed at all. And that's what's called blowing through a stop. In fact, fast forward 30 days from your purchase and you can see that the stock price just continued to fall. So your stop limit order with an activation price of $132.50 will not get executed until the price rebounds back up to that point. And who knows how long that could take. It could be a couple of days, could be a couple of years. That's what makes trailing stops so useful. A trailing stop is an order to sell that automatically adjusts the stop price at either a fixed percentage or fixed dollar amount. This helps when it comes to locking in profits as the price increases, and the adjusted value can only go up. So as your stock price goes up, so does your adjusted stop. But if the stock price goes down, your adjusted price stays exactly the same. Now, I'm going to show you what I'm talking about in a second. But first, how do you set a trailing stop? Well, back to our online order form, where in this example, we're buying 100 shares of General Motors, but this time in the order type, we're going to put trailing stop percentage. And you'll notice there's a new field that's going to require some information, and that is stop parameters. If it is a trailing stop percentage, in that parameter you are going to put the percentage of allowable loss. And that can be 2%, it could be 10%, whatever it is that you want based on the amount of risk you're willing to take on. And of course, if it's a trailing stop amount, in the stop parameters, you would put in a fixed dollar amount. And that could be, again, $2, $10, whatever it is that you want. It's the 21st of January again. And this time you have put in a trailing stop percentage order at $134 with a stop parameter of 5%. That would make your activation price $127. But you see, with trailing stops, as the price increases, your activation price trails the new high. So during the course of this day, the stock saw a new high of $139.50. And when it did, the activation price adjusted to $132.50. Now, for the sake of these examples, we're going to assume that the price action is all chronological, meaning that you got in, the price went down, then it went to its high, and then back down to its close, because it's not always going to work out this clean. And I'm going to show you an example of how things can go haywire later on in this video. The 25th of January rolls around, and the stock has seen a new high of $145, thus adjusting the activation price to $137.75. The 26th of January comes around, and the price comes down a little bit. And because the stock has not seen a new high, the activation price stays the same. The stock price continues to fall in the days to follow, and it's not till the 28th that the stock price actually hits the 137.75, and when it does, it becomes a market order and a sell order is initiated. And in this example, you would have locked in $3.75 per share realized profit. Okay, same day, same company. This time, it's a trailing stop with a dollar amount. So, you got into your position at 134 bucks and your stop parameter is $5. That would make your activation price $129. The stock sees a new high that day of $139.50. Your adjusted activation price is $134.50. The 25th sees a new high of $145, adjusting your activation price to $140. On the 26th, the stock does not see a new high, so the $140 activation price stays the same. Stock price continues to fall over the following days, and sometime during the day on the 28th, the activation price is hit at $140, becomes a market order, and the sell order is executed. And in this example, you have locked in $6 per share in realized profit. Sounds awesome, right? So what's the problem? Well, the first problem I had already mentioned, and that's blowing through the stop. If you're putting a very specific activation price on there and it gaps down past the price and then continues to fall, well, it's like you didn't have a stop loss on there at all. The second problem is getting stopped out prematurely just through intraday price volatility. I'm going to show you what that looks like right now. So remember when I said that for the sake of these examples, we're going to assume that the chain of events are chronological, meaning that you get in the position, then the price goes down, then it shot up to a high and then came back down right before the close. That is in its most simplistic form for the sake of understanding exactly how these trailing stops work. It will seldom be that clean. So let's take a look at what we know about the price action of XYZ Company on the 21st of January. Well, we know that it opened at $134. We also know that it closed at $136.90. We know that at some time during the day, it hit a low of $133.50 and saw a high of $140. What we don't know is how many times it went back and forth. I mean, it could have went from $140 to $135 and back 10 times during the course of the session. It could have went from $133 to $135 20 times during the course of the session. And here's why that's important. I want you to follow me on this. 9:30 a.m. the price is $134. That's when it opened. And that's followed by a buying frenzy. And an hour later at 10:30 a.m. the price is at $140. That is its session high. Well, that just happened to be when the bears show up and they drive that price all the way down to $133.50. That's the session low. And anticipating that that was the low, you get in at 11:35 in the morning at 134 bucks. That's when you set your trailing stop with a $5 stop parameter. And lucky enough for you, the bulls got your back and they drive the price up to 139 bucks. Not quite 140, but that is the new high since you got into your position. And that adjusts the AP to $134. Well, again, the bears show up to the dinner table and they drive that price right down to $134 by 3 in the afternoon. And guess what happens then? You get stopped out. But not before the bulls show back up and drive the price back up to $136.90, right in time for the close. So in this scenario, you've accomplished absolutely nothing. So back to the online order form where we are buying 100 shares of General Motors, and this is going to be a trailing stop with a $10 stop parameter. And of course, time and force must be selected before executing the trade. And if you recall from the previous video, time and force is the amount of time you want your order to be good for. And that is either going to be till the end of the day or GTC, good till canceled. And if you're selecting GTC, you'll also notice that there is a date that you can set it as far out as your broker will allow you to. If everything looks good, you go ahead and place your order, and that will be that. So what did you learn today? Well, you learned the difference between a stop market order and a stop limit order. You now know what a trailing stop is. You know what it means to blow through a stop. You know why you should be using stop losses and what the drawbacks of them are. Thank you so much for watching, and don't forget to subscribe and hit the bell icon so that you can be the first to know when fresh videos are dropping. And please, if you felt that this information was useful, hit that like button. The split second it takes to do that means so much to me and my channel, and we will certainly look forward to seeing you again next time. And until then, stay profitable.